Welcome back to Econsphere, everyone, and in this very first episode of our Wall Street Radar series, we are diving deep into what happened in the American stock markets this week and what it could mean for investors heading into the next one. Because, as always, Wall Street never sleeps, and volatility continues to shape opportunities and risks. So let us break it down step by step, starting with the big picture where the S&P 500 managed to climb nearly 2% last week, holding firmly above the 4,800 level. The tech-heavy Nasdaq surged close to 3% thanks to strong momentum in artificial intelligence-related stocks and is once again knocking on the door of that psychological 16,000 mark, while the Dow Jones Industrial Average showed a more modest gain hovering around 38,000. Which tells us that investor appetite for risk is clearly tilted toward technology and growth shares at the moment. Nvidia continued to be the star of the show as demand for AI chips remains unprecedented, pushing the stock to fresh all-time highs. Apple showed resilience with solid growth in services revenue and anticipation around new product cycles. Microsoft extended its leadership in cloud computing and AI integration. And Tesla, despite slightly weaker than expected production numbers, remains in focus as the long-term electric vehicle trend keeps investors engaged. All of which reminds us that while short-term volatility can be unsettling, the long-term growth narrative in tech is still intact. Meanwhile, the Federal Reserve continues to sit at the center of every investor's decision-making process. Inflation data came in a little cooler than forecast, but core inflation remains sticky. And that means while markets are eager to price in rate cuts the Fed is unlikely to rush, most analysts believe rates will remain elevated at least until the second half of the year. Bond yields pulling back have supported equities recently, but the labor market still looks strong, and that gives the Fed little urgency to pivot aggressively. So we are caught in this classic push-and-pull dynamic where investors crave looser policy, but macro fundamentals do not quite allow it yet. And this is where psychology becomes just as important as fundamentals, because markets are driven not only by numbers, but also by emotions. And we've all seen how fear of missing out can lead to overextended rallies, and how panic selling during dips can create unnecessary losses. As Warren Buffett famously said, markets in the short run are a voting machine, but in the long run, they are a weighing machine, which means that today, noise can feel overwhelming. But the real driver of wealth creation is patience, discipline, and focusing on intrinsic value. Technically speaking, the S&P 500 has a key support level around 4,750, while the 4,900 zone represents immediate resistance, a clean breakout above that could open the door for a new leg higher. The Nasdaq is finding support near 15,700 and bulls are eyeing a push through 16,500 as confirmation of further upside. The Dow, meanwhile, is supported at 37,800 with 38,500 acting as the ceiling that needs to be broken to sustain momentum. If you are an investor watching these levels, it is important to remember that support and resistance are not just numbers on a chart. They are psychological battlegrounds where bulls and bears fight for control, and knowing how to read them can help you avoid emotional mistakes. Beyond equities, safe haven assets like gold and silver are still playing their balancing role in portfolios offering protection against uncertainty, while cryptocurrencies remain volatile but attractive to those willing to embrace risk. So diversification remains key. Looking ahead to next week, all eyes will be on a wave of corporate earnings with Apple, Tesla, and several other heavyweights set to report numbers that could move the entire market. At the same time, comments from Fed officials will be parsed for any hint on the timing of rate cuts and economic data on consumer spending, and inflation will further guide sentiment. In short, the coming days are going to be pivotal, and as always in markets, preparation beats prediction, which is why we are here at Econsphere to help you make sense of it all. So stay calm, stay diversified, and remember that investing is a marathon, not a sprint. Thank you for watching the very first episode of Wall Street Radar. If you found value in this breakdown, make sure to hit the like button, subscribe to the channel, and leave a comment with your thoughts because together we are building a community of smart, disciplined investors who can thrive no matter what the markets throw at us, Until next time, this is Econsphere signing off. Keep your eyes on Wall Street, keep your strategy strong, and we'll see you in the next episode.